Where is the money? You can only find that money in accounting. Accounting is sweet. If you think accounting is just boring math and spreadsheet, think again. Accounting is the secret of business. Whether you want to start up a new business, invest in an existing business, in shares and stocks, or land a high-paying career, you need to understand this language. Today, we are breaking down Module 1 with zero confusing jargon. Let's dive in. Module 1, Accounting 101, the secret language of business. The language of success, mastering accounting foundations, demystifying the core principles of accounting. As we continue, please like, comment, share, and subscribe. The meaning. Accounting is the process of identifying, measuring, recording, and communicating financial information to users of the information so that they can make the right business decisions, what we call informed decision. Think of it as a financial diary that tracks every single penny moving through a business. It's like the input, which is the transactions, data entry, that's the input. Then the process in recording and sorting, then output, financial reports. These are the things, the processes that accounting pass you through. What are the objectives of accounting? Why do we do accounting? For systematic recording, of course, to avoid relying on human memory for tracking money. We need to have systematic recording. If not, our brain will fail us. So when something becomes old, we forget them. But if we have a good accounting record of it, we will not forget. For profit determination, we want to know whether our business is making profit or whether our business is making loss. If we don't keep records, we cannot determine whether our business is making money or we're losing money. And this is the basis of every business, to make money. No one wants to lose money. It is only through accounting that you can find out this. We want to find out the financial position of our business. Is our business increasing in value or decreasing in value? Our assets, how do we finance them? Did we borrow money to finance them, or is it our money? What about the capital that we use to start the business? Is it increasing? Are we making profit and putting it back in the business? These are things that we need to know about accounting. Then we have to make decisions based on the records that we have kept. It is accounting that provides the data and transform it to information that helps us to make decisions, so that managers can plan ahead, business owners can plan ahead, investors can make decisions on where to invest. This is through accounting. Now, who are the users of accounting information? We have the internal users and the external users. Of course, the internal users are the managers, the employees, and owners / shareholders. What do they use it for? They use it for pricing and pricing decision. They use it to prepare financial statements to determine financial performance of a business. The employees want to know whether their jobs have security or the job is not guaranteed. Through the financial statement, through accounting, they will understand if their job is secured. The managers want to use it to make decisions on how to price their products, be it service, be it goods. The owners of the business want to know the value of their business, whether their business, their investment is doing well or is crumbling. It is through accounting information that they have this information, which will help them to determine whether they should continue in the business or not. Then we have the external users. These are people from outside the company. They are not inside the company. We have the creditors and the banks. The creditors can be made up of people that either lent money to the business or people that supply goods on credit to the business and they are not paid. Immediately they supply the goods. These are creditors or banks that loan money to the business. They are part of the external users. They are outside from the company. They are not members of the company. Then we have the investors. Those who want to invest in the business, they want to use their money to either buy stock or to invest in a way that they feel is fine for them to realize their profit or gains. Then we have the tax authorities, the government, who want to use the accounting record to know how much the business will pay as tax and to know whether the business is avoiding tax or evading tax. These are also users of accounting information. We have the customers. The customers buy goods from the company and they want to know whether the company is stable and can be supplying their goods as and when they need the goods, so that if it's not going to work, they might decide to try another company. So these are users of accounting information. They use the financial report that is produced through accounting that we call general purpose financial reporting. Branches of accounting. We have different branches of accounting. We have the financial accounting, which focuses on recording past transactions, prepares standard reports like the financial position and income statement for internal and external users, basically for external users. Then we have the cost accounting. This focuses on cost of production, the cost of producing goods and services. This helps the business set prices and eliminate waste. These records are used by cost analysts. It's used to reduce waste. It's used to analyze costs. We have the management accounting. This focuses on internal reporting, forecasting, and budgeting. It's used exclusively by managers to make future business decisions. It's an internal report and it's used internally only. Then we have the tax accountant or tax accounting. This focuses on tax planning and preparing tax returns to comply with government laws. So this one is a branch of accounting that the duty is to prepare for government tax audit, file returns of tax. And then we have the auditing as also a branch of accounting. Auditing is also another branch of accounting. This is the independent verification of financial records to ensure accuracy and honesty. It checks the internal control of the business, whether the accountants or the business is following the laid down rules. So I am showing accounting pictorially as a tree that has different branches. These are the branches that we have just mentioned. Accounting careers and professional bodies. So we have different career paths in accounting that you can choose to follow. As you read accounting or as you study accounting, you are not tied to any particular business or career paths. You have different career paths that you can choose. You can choose to be a public accountant working for firms to audit either companies or file their taxes. That's the work you can do. You become an accounting practitioner. You have an auditing firm that you work either for or you open by yourself, an audit firm. For you to do that, you need to become a member of a professional body. We have the global body, we have the international body, we have the regional bodies, which I'm going to mention. But first, if you are a public accountant, it means you work for accounting firm. Either your own firm and you serve the public. You serve corporate bodies from your own firm by auditing them or filing their taxes. That's public accounting. Then you have the corporate accounting, and you are called a corporate accountant. You manage the internal finance of specific business, e.g., Dangote Cement, a university accountant, a company accountant. These are different accounting career paths that you can follow. We have the forensic accountant, acting as a financial detective to investigate fraud and white collar crimes. You give reports in court where there is a court case. You are called to come and give a forensic report through the investigations you have made. Then we have managing public funds and tax enforcement. This one, you are working in the ministry, you are working for the government, you are working in the tax office, and so on. Now, professional accountants have professional bodies that cover them. We have the global body like the CPA, CMA, and or what have you. We also have the international bodies like ACCA. This is in UK. And then we have in Nigeria ICAN and ANA. These are accounting bodies or professional bodies. To become a trusted elite professional, you need a designation, chartered accountant, either ACCA, ACA, ANAN, CPA, and so on. You must belong to one of these organizations. You can also be a designer, designing accounting softwares and financial data systems. This is basically taken by accounting information system. You can be an accounting information system specialist, designing and securing accounting softwares and financial data systems. You can also be an accounting teacher, an educator, like lecturers, secondary school teachers, and so on, that teach accounting, teaching future accountants how to become accountants. For you to be a system accountant, you must also develop yourself in the digital technology. You can be a member of CISA or ICAN. As an accounting teacher, in America, we have what they call AAA. You can also have a PhD in accounting. These are ways of becoming an accounting teacher. Accounting career path, a comprehensive guide. So we can look at education and certification. Entry levels: junior accountant, corporate accountant, accounts payable clerk, also a corporate accountant, accounts receivable clerk, public accountant, staff accountant. You can also go for the mid-level roles when you grow from the entry level to become a senior accountant, to become a financial analyst, to become a budget analyst, internal auditor, tax associate, forensic accounting investigator, accounting manager, cost accountant, payroll manager. Then the senior and leadership roles: controller, what we call financial controller, chief financial officer, CFO, VP of finance, that's vice president finance, can call it director financial officer, audit partner, public accountant. You can be part of a firm and you're a partner in that firm. That's a very senior level. Imagine being a partner in Deloitte, how prestigious it is, or one of the big fours. Chief executive auditor, or treasurer, or a financial consultant. So this requires you to be a member of at least one professional body. The professional bodies are CISA, like I said, CITN2 for the tax practitioners, Federal Institute of Taxation of Nigeria, ICAN, ANAN, and so on. Accounting concepts and conventions. Accounting concepts and conventions. These are foundational guidelines through which accounting is rendered. These are fundamental principles that keep accounting practices uniform and reliable worldwide. They are like guides on how to record accounts and how to prepare it. It ensures that the accounting has a global language. Now, there is international financial reporting standards that have been developed to ensure that there is uniformity in preparation of accounts and there is consistency and accounting can be comparable wherever it is prepared. These are core concepts for the business and for the owners. The key conventions are: one, entity concept. This tells us that the business and its owner are completely separate legal entities. They are not one. Even though you are the owner of the business, you are different from your business. So because of the personal expenses must be recorded as personal expenses. It will not be mixed with business expenses. So in a sole trader business, it is seen as drawings. When you make expenses, your own personal expenses, it's seen that you made a drawing from the business. So it will be recorded there. It's not going to be part of the profit expenses of the business. The same way, if you brought in money into the business, it's not going to be part of the income or revenue of the business. It's going to be seen as capital contribution, director's contribution into the business. So that is a concept of entity, that the business is separate from the owner of the business. Then we have what is called going concern, the assumption that the business will continue operating indefinitely and will not shut down anytime soon. The business will continue to exist. It will not shut down. The death of the owner of the business does not kill the business. Even if the owner of the business dies, the business continues like that. Now, it is because of the going concern assumption that we have what is called periodicity or periodic accounting. Because since the business is indefinite in life, you will not wait to prepare the account at the end of the business because it will not end. Therefore, you have to split the reporting period. We have what is called accounting year, a 12-month calendar year, right? Which can be from January to December or from February to January and so on. It does not matter when it started. What is important is that the period is going to be 12 months. Except the regulators who might also want to have reporting on quarterly basis or in 2 times a year. There are some regulators that can fix that too. Then we have the money measurement concept. Only transactions that can be expressed in monetary terms are recorded. E.g., high employee morale is valuable, but it is not recorded in the ledger. So when you can express something in monetary terms, that's only when we record it in accounting. It's called money measurement. So everything is brought down to naira and kobo. The managers of the company is seen as naira and kobo. The business of the company is seen as naira and kobo. The employees of the company are seen as naira and kobo. Whatever that is in the company is to be expressed in the form of naira and kobo. Another one is dual aspect. Dual aspect of accounting. Every transaction has two sides, a debit side and a credit side. This keeps the accounting equation balanced. The debit and the credit must balance. So we have the accounting equation that says assets is equal to liabilities plus equity, where assets are the resources of the business, like the properties the business use to make money, what they use to pursue revenue or generate income for the business. These are assets. And then liabilities are money that they borrowed or goods that was supplied without them paying for it by the company. And then we have the equity, which is the capital of the owners of the business, what the business owners brought into the business. So we're saying that assets must be equal to liability plus equity. What it means is that the asset of the business is owned by the owners of the business and those who lent money or supply goods or credit to the business. These are the people who finance the asset. So we say that they have a claim in the business. So every transaction must have a debit entry and a credit entry. That's the dual aspect of accounting. Then we have the convention of prudence or conservatism. This wants accountants not to anticipate profits, but provide for all losses. Do not overstate assets or income. So this is important so that you will not make somebody happy that my business is making profit when actually the business is making losses or it's not making any profit. So you don't anticipate profit that I'm going to make 50,000 naira. I'm going to make 80,000 naira. I'm going to make 100,000 naira. Then you record it. No, you cannot do that in the principles of prudence or conservatism. That's why they say accountants are very, very conservative. But however, when you see that there is going to be a loss and you can measure the loss reasonably, you can estimate the loss reasonably, determine the cause of the loss and others, you can record the loss. You can recognize the loss. So this is different from the rules of income. We have a lot of accounting concepts and principles as it's in this rule book that you are seeing. We will not be able to define all of them. Maybe along the line in this module or in the next module, we are going to define them. We have the equity, periodicity, monetary unit, going concern. These ones I've talked about them. We have the historical cost, revenue recognition, matching, full disclosure. We have faithful representation, comparability, verifiability, timeliness, understandability. We have other rules, the prudence, the materiality concept, the consistency concept, and some industry practices. When we are considering all these rules, we must consider cost benefit. Most of the recording of accounting, whether we're talking about materiality, consistency, or whatever, we must also consider the cost benefit because If it will cost you more to recognize an item in the accounting than the benefits you get, it is better you abandon that cost. A situation where you're going to spend 100,000 naira in order to ascertain a profit or an item worth 50,000 naira. At the end of the day, you see that you are spending more money than you are gaining. So cost benefit is very, very important. Then we talk about industry specifics. When we talk about materiality, it depends on the industry. Which industry do you belong? How big is your industry? 1 million might be nothing for a company that is making billions of naira. Whether 1 million is so much for a company that is making tens of millions. Then 50,000 can be something for somebody who is doing small POS business, call business, and all the rest. If you remove that 50,000, maybe that 50,000 is even the capital, it's material. But the other person who has a very big business, that one is not material. So materiality concept is talking about any item whose omission or misstatement in the accounts will lead to error in your decision making or interpretation of the account. So these are company or industry specific. My viewers, we have gone far in this module one. This is just to introduce accounting to you. We will continue to teach accounting so that those who do not know accounting and are ready to know accounting can, through our series, become experts in accounting. So we want you to like, comment, share, and subscribe. We are going to go to module 2 in the next episode, which will talk about the real accounting, debit and credits, the recording rules. This wraps up module 1. You now know the foundation. In module 2, we are going to look at the actual rules of debits and credits and how to record transactions. Drop a comment below. Which accounting career sounds most interesting to you? Don't forget to like, subscribe, and hit that notification button. Let the bell ring in your ear as you hit the button. See you in the next video. You can ask questions if there are things that you need clarification. In the comment section, we will respond to you. Thank you.